Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. What a day, what a day. We have had explosive fireworks in financial markets today, following the first day of semi-annual testimony from Fed Chair Jerome Powell. And what we're going to talk about here, because of course we took a deep dive into this yesterday before Powell spoke and kind of laid out what was likely to happen. And indeed, it happened as we said. We had the expectation that the ball was moving in the wrong direction for the Fed, and that what was likely to happen was Powell was going to reiterate a willingness to fight back, and that the response for this could be a stronger dollar, weaker stocks, weaker gold, higher yields. And indeed, that's exactly what we saw in markets today. And boy, did we ever. The moves were absolutely huge, basically across the entire spectrum of benchmark assets. So what we're going to do here, just at the start of our session here, is really boil down how one could have anticipated this, what it was that was critical. And of course, yesterday we went and looked at this in exhaustive detail. Today, we're just going to look at two charts and one table. And the table, frankly, is just secondary, just to see where we are in rate hike odds for the Fed now. But there's really only two charts that you need to see in this environment to get a sense for what is occurring. And I wanted to kind of dwell on them a little bit rather than go through a whole sequence of various things, and really get a sense for how you could do this yourself, how you could look at this and say, I get a feel for what the macro is. And then we're going to look at the Bank of Canada, which has a policy announcement coming up over the course of the next day, and get a feel for something that's very intimately attached to the U.S. business cycle, but where monetary policy is doing something different, and where we might get some second-order effects following the volatility from earlier today, and get another big bout of what is going to occur here. So, with that in mind, let's begin with the first chart that we wanted to look at for gauging where Powell was likely going to go in the speech today. This is very simple. What we're looking at here is the performance of U.S. economic data relative to expectations. So you get a bunch of economists. They're typically polled by the likes of Bloomberg and Reuters and various analytics firms and aggregators that essentially go to all of the people that build models and do analysis and create expectations for U.S. economic data outcomes. Those then get averaged, or you take a median, and you get the baseline expectations that we live with every single time that a piece of data comes out. This is when you get those statements like, the market expects XYZ data to be ABC outcome. That comes from surveying of economists who typically have models that, based on various economic inputs, will give you, here's the expected number for CPI, say, here's the expected number for GDP or NFP or whatever you like. And what this curve is telling you here is, first of all, when it's positive, data is doing better than those expectations, than those economists have expected. When it's negative, it's doing worse. The higher it goes into positive territory, the better it's doing. and the more reactive markets are, and vice versa. So what you see at the start of February is U.S. economic data is doing better than economists' models think it should. In other words, there is an unexpectedly strong U.S. economy. The question then becomes, has the Fed raised rates enough to contain the inflation that comes with having a stronger economy? Because, of course, more economic activity means more money changing hands, means more inflation. The two go hand in hand. And so when you get to this kind of a situation, the natural question to ask is, okay, well, the Fed has done a tremendous amount of tightening already, 425 basis points last year. They continue to signal more. And indeed, before we were even going into this pop in February, when we were still in January, we were looking at economic data looking kind of flat-ish and starting to get a little bit soggy. There was a sense that, okay, well, the Fed has done enough. We're going to probably have a peak in rates somewhere between 4.75 and 5, or 5 and 5 and a quarter. The Fed moves in ranges, so it's always a target range of 25 basis points. So there was a fairly firm sense, and you can see here on the chart as economic data starts to flatten out, you get the sense that, okay, well, the economy has reached a sort of steady state where it's not improving, it's not getting better as it did in the first half of the previous year, or certainly the second and some ways into the third quarter, but instead it's kind of idling. So maybe the Fed has right-sized the amount of tightening. Maybe there's not more coming. And that becomes especially the case from November onward, when you can see economic data actually takes a turn lower and starts to deteriorate a bit relative to expectations, which, not surprisingly for markets, means, okay, well, the Fed tightening is starting to have the negative cooling effects on growth that it's supposed to have. It's just starting. We all know that there are long and variable lags, to use a cliche, in monetary policy. And so we're going to have a situation here where all this Fed tightening is slowing things, and eventually that will get the Fed to stop. And they'll keep going, let's say, up through mid-year and stop there. And then you get the run of economic data we saw last month, which clearly challenges that idea. And so the question becomes, has the Fed tightened enough, or do they need to tighten more, given the economy is stronger now than it looked earlier? This brings us to our second chart. And the idea here is that to answer that question, you don't actually need to live inside Jay Powell's head. You don't need to sit on FOMC policy announcements. The collective wisdom of the market can answer that question for you. And what you see in the yellow bars there is the 2-year break-even rate. What is this? You have nominal yields. So that which we always talk about, the cost of borrowing for the U.S. government. 2-year yield, 10-year yield, 5-year yield. And then you have real yields. So those yields, but discounted by the expected rate of inflation. So you can buy a TIPS bond, which gives you a real yield that is net of inflation expectations. When you take the difference between those bonds, the nominal one that doesn't have an inflation adjustment, and the one that does have the inflation adjustment, what you're left with is the magnitude of that inflation adjustment itself. What that tells you is essentially what the market is pricing in to be inflation for whatever the tenor of the bond, be it a 2-year bond, so where inflation is in 2 years, 5-year bond where it is in 5 years, 10-year bond in 10 years, etc. Simple arithmetic gives you that expectation of inflation, and that is what the break-even rate is. Not surprisingly, markets are forward-looking, so they anticipate shifts in inflation based on incoming economic information on any given day. So the yellow bars you see there, they're monthly bars. What you see there is the direction of travel for that 2-year, so the nearer term, inflation expectation. So well within the Fed's window of action. If one were to say, if the Fed's target is to aim for inflation at 2% in the medium term, 2 years is about the medium term. The only central bank, incidentally, that I've ever seen define the medium term has been the Reserve Bank of New Zealand, RBNZ. They've said it's a 2 to 3 year window in a research piece. So a 2-year break-even rate is about medium term, certainly within the realm of how far the Fed tends to forecast where things are going. And what you see here is that's running about 2 months ahead of realized inflation. So you can see here, if we take the baseline measures of U.S. inflation, PCE, CPI, and we lag it by 2 months. So we pull it 2 months into the past. You can see it lines up just about as perfectly as it can with these expectations. So the expectations are anticipating with about a 2-month lead, and or at least they have been for a few years now. This data you can see goes back to the beginning of 2018. So we're talking about 5 years here, essentially, a little bit more. It tends to anticipate, the expectations do, what realized inflation is going to see. What the key insight here is that in the face of this economic data getting better, right there, the yellow bars go higher. And so it's not so much that there is a debate about whether Fed's actions so far has been sufficient and fully priced in, and they're not going to go higher, or the alternative. It's that the market has spoken. And it has said that the amount of tightening baked into markets as of February in particular, and now March, the last 2 yellow bars on this chart, that the amount of tightening already baked in will not be sufficient to bring inflation to 2%, because both of these are readings north of 3. So you don't really have to go far to look at this and say, well, clearly the Fed is going to have to do more if 2% inflation is what it wants to do. Because if this pickup in U.S. economic data is not being seen by markets as bringing inflation down and is in fact being seen by bringing inflation up, what else could the Fed do? I mean, ostensibly, they could change their inflation target. But what we've heard from Jay Powell over and over and over again, and other Fed officials over and over and over again, is that's not even remotely on the menu. And it makes sense why it's not. Because so much of what the Fed does is linked to credibility. changing the goalposts would significantly undermine the Fed's ability to set any kind of policy to begin with, unless it were really justified. And so what we see here then is the inevitability of what we saw today. Perhaps the more surprising thing is that the markets reacted as aggressively as they did to a message that could have been anticipated. And so clearly the markets were not fully appreciating where this is going, but it was readily observable that things were beginning to develop in a way that the Fed would not find to be a trend in the direction that it wants. And that the only logical thing then would be to push back harder or to just keep going. And so all of this just directly follows from what the markets are already showing. If the markets thought that what the Fed had done had been enough, even with the pickup in economic growth, if that pickup in economic growth was in fact good news from the Fed's perspective and the market's perspective, these yellow bars would not be going up. But here they are. And so there really was no other way but for the Fed to sound more hawkish, which is, of course, exactly the aggressive reaction that we saw today, something the markets still were not ready for. And the kind of situation where the long side bias, in particular in equities, where equities are overwhelmingly owned by giant pension funds and endowments and other huge institutional level investors that never go short and so have a bias favoring the long side, there was necessarily going to have to be some kind of an adjustment because there is nothing else the Fed could have said. And so these entities that are sort of perpetually searching for the time when risk is back on, we're always perhaps going to be at risk of being caught off sides here. And so if you're watching the macro and you're thinking, well, surely everything is already priced in, here it is readily observable, well, clearly not. Because just in being readily observable does not mean that the market is not going to get surprised. And clearly, here we are. This is the outcome that we had today. Now, hopefully that gives a bit of ammunition on how to read this going forward. Look at where we've ended up now. We're looking at 4 rate hikes, so a full percentage point now fully baked in for this year. So a meaningful chance now of a 50 basis point hike in March, 62%. A shallower but nevertheless non-negligible now likelihood of a 50 basis point hike in May, 33%. And then rates well in excess of 5.25% already into next year, which is, of course, an upshift relative to where we were yesterday by about a rate hike's worth, about 25 basis points. So we've shifted from sitting in a kind of 5.25 to 5.5 range to a 5.5 to 5.75 range. And what we're going to see tomorrow will be more testimony from the Fed chair. The prepared remarks are likely going to be almost indistinguishable from what we saw today. But of course, the Q&A will be different. Different questions, different answers. So there is a level of reactivity that markets still have to all of this. And so there's still something here to consider. There's something here that may have follow-on volatility in it over the next day still. And then, of course, with just a bit of air on Thursday, you end up on Friday with U.S. non-farm payrolls, which, if U.S. economic data continues to outperform to the top side, is perhaps an opportunity to drive this further still, because you get another upside surprise, maybe. We'll talk about that on Thursday. What we'll talk about now is what's coming up in the more immediate future, which is the monetary policy announcement from the Bank of Canada. And this actually is very much anchored into our conversation about what's going on in the U.S. Because Canada, of course, is attached at the hip to the U.S. economy, both literally and figuratively. We're looking at a central bank that has actually moved more so on the sidelines. And you can see the policy curve hasn't really shifted over the past week, so expectations have been fairly stable. And in all, the back half of the forecast, so from 6 months and further out, there has been a bit of a hawkish shift since the last policy announcement, which was in late January. So you can see we're still looking at about the same setting of rates. Notably, of course, the U.S. is screaming past the 5% mark. Here, it looks like we're going to top out under it and not even get to 4.75. But you can see 1 year out, 2 years out, 3 years out, the structural setting for rates in Canada a little bit higher now than it was when the BOC spoke last. So there has seemed to be a pickup in expectations. What we have as far as the priced in outlook for this meeting, no hikes on the board here. Only about 11% chance of a hike being baked in, 22% chance of a hike for the April meeting. We get just to about a third into June, so 34, almost 35% a chance of a hike there. So you can see we've kind of crept up a bit, but really we don't get into rate hike expectations until September, until October. And there it looks like we might get one more, taking us to a rate of 4.75. So maybe we're going to get something that occurs somewhere between April and July. You can see there we're getting close. We've baked in 24 basis points if you look at that implied rate delta there, but we don't really get the full thing baked in until about September. So much different than what we hear from the Fed. Maybe one more hike this year is what this seems to be saying. One is baked in, and it already starts to kind of look flimsy by December. You can see we're down to 21 basis points there. So much more shallow, much more dovish. Meanwhile, you could make the argument that the reason this is happening is a lead from housing. Housing is a dominant component of inflation in Canada. It is over a third of CPI, and you can see that the price of housing has come down significantly, and there's about a 10-month lag between that rate, so the rate at which house costs are going up, and the rate at which CPI is growing. And so if you make that adjustment for the 10-month lag, you can see that housing has long since topped. And so perhaps that is something that will give us a further come down in CPI CPI. So you could make the argument here, to give the BOC their due, that it might make sense to back up here because inflation is already going in the direction that ostensibly you think it should. But not so fast. And this is where the influence of the U.S. economy really starts to be an important input. We've obviously just discussed that U.S. economic data has been getting better last month, that the U.S. economy has been looking stronger. Well, Canada exports over 80% of everything it sells abroad to the United States. That shouldn't be surprising, obviously. We have a situation where not only do we have essentially unencumbered commerce, we have a free trade agreement with Canada, but most of the population in Canada lives clustered to the U.S. border. Most economic activity takes place with the United States. Until recently, it was easier to do business for Canadian provinces with the U.S. than it was to do business with each other. And so there's a very strong knock-on effect from what's happening with U.S. performance on outcomes in Canada. And so what you see here, this is the latest set of manufacturing PMI numbers out of Canada in the red there, and in the orange, a 1 month lagged break even, to give you a sense for economic data outcomes feeding into inflation expectations with about a 1 month lag in this case. And so you can see that inflation expectations are starting to go up in Canada, largely because a buoyant U.S. has given us a pickup in activity in Canada over the past 2 months or so. The impact that this might have on CPI seems fairly clear, and about as clear as we saw it in the U.S. So there's about a 2 month lag between, in this case, the 5-year break even, which is the liquid one in Canada. There's not a 2-year liquid one in Canada. So we have to contend with a 5-year. But you can see the relationship is very similar here. About a 2 month lag for CPI as relative to market expectations. And you can see those market expectations have turned up because of that pickup in demand and because the U.S. has been doing relatively better, which seems to beckon the BOC to reconsider, to perhaps move harder, to perhaps hike more. Now, does that necessarily mean that we're going to have a rate hike tomorrow that's unexpected? No, I don't think it necessarily means that. But it does mean that the messaging from the Bank of Canada might become much more hawkish. That point is driven home here, where you see in the orange the Canadian dollar, 6C, the future there. And then the spread between U.S. and Canada 5-year break even. So essentially, how inflation has been developing in the U.S. versus in Canada. And what you see here is a positive spread. So inflation has been higher in the U.S., which ostensibly justifies more aggressive rate hikes in the U.S. But what you also see is from the beginning of last year, that gap has been closing. So the red line has been moving lower, to essentially suggest that the gap between inflation in the U.S. and Canada has been narrowing. The amount of inflation in the U.S. has been exceeding the amount of inflation in Canada by an increasingly small amount. And the Canadian dollar has not surprisingly weakened, because what this has meant is that inflation is devaluing the purchasing power of the Canadian dollar as relative to the U.S. dollar. As the amount of inflation in the U.S. relative to Canada gets smaller, again, not in absolute terms, in relative terms, and the BOC doesn't respond, the currency weakens. Now, for the BOC, this is, of course, exactly counterproductive, because a weaker currency will make the price of goods higher in terms of that currency, certainly of imported goods. And what that ends up doing is undermining the central bank's efforts to contain inflation, because what is inflation but a rise in prices? And so what you see here then is the Canadian dollar sinking and approaching that former bottom that we saw right around the fourth quarter of last year at around 72 on the futures contract there. So what then becomes the upshot for this is, if the Bank of Canada sticks to its guns, well, then maybe you bust through that bottom and open up space for a much more significant decline in the Canadian dollar going forward. But if not, if the Bank of Canada takes these cues and says, if we don't act, and the Fed keeps doing more on its inflation story than we do on ours, but what happens in the U.S. is intimately tied to us, we're going to perhaps end up in a situation where our inflation situation starts to erode our currency more and at a faster rate, perhaps, than what's going on in the U.S. as relative to the U.S. dollar. And this will be imported inflation for us. So we need to push back on this now. And so maybe then what you get amongst all of the various currencies, all of which suffered against the greenback, thanks to Jay Powell's comments today, maybe you get a snapback. Because a hawkish Bank of Canada says, actually, we know you think we're not going to hike rates near term. Burn that script. We're back in action. And so one way or another, the Canadian dollar might be a particularly reactive currency and a particular pocket of volatility over these next 24 hours because of this disconnect in what the Fed is doing and what the BOC is expected to be doing, and really the volatile implications of whether they choose to stay the course or not stay the course, one way or another. And that is macro money for today. We are here every week, Monday through Thursday, attempting to unpack these various macro forces and how they drive financial markets. That follows immediately after overtime with our friend Chris Vecchio, head of futures and forex here at tastylive. You can also catch me at 4:55 Central, 5:55 Eastern, 2:55 in the Pacific, where I am, on Sundays with Tom and Tony for First Call. And outside of those shows, and this one, you can follow my various ideas on markets via Twitter at Ilya Spivak. Thanks very much for joining. Speak to you guys tomorrow. Take care.